taxable profit. In the computation of taxable what? A profit. In the computation of taxable what? A profit. So this one is caused by taking into account certain items of incomes and expenses, items of incomes and expenses, items of incomes and expenses only in the computation of the taxable what? A taxable profit, but those items are not taken into account in the computation of taxable profit. And automatically you know which are these items. Which are these items of incomes and expenses? These items are non-taxable incomes and disallowable expenses or non-deductible expenses. For example, what we know in computing the accounting profit, we may take into account expenses such as penalties, fines, amortization of assets. So all these are expenses, penalty, fines, and amortization. So we take into account all those particular expenses in the computation of accounting profit. But basically what we know in taxation is that those expenses are non-deductible or they are disallowable expenses. That's basically what we know. In computation of the taxable profit, you don't, or basically those items are not taken into account. We don't take into account penalties, fines, and amortization of assets, including impairment loss on goodwill. So automatically, that will give rise to a difference between, or make the accounting profit and taxable profit to be different. And that difference is known as what? The permanent difference. The permanent what? Difference. Now, we say that this difference basically does not give rise to deferred tax. And therefore, in the computation of deferred tax, this difference is what? Is ignored. This difference is what? Is ignored. So the question you may come across in relation to that in an examination setup is just whereby you're required to explain what is permanent difference. Sasa? Yes. Now, on the other hand, when we talk about the timing difference, this is the difference which is occasioned by taking into account items of incomes and expenses, items of incomes and expenses in the computation of two profits, the accounting profit and taxable profit, but in different accounting period. But in what? Different accounting period. Different accounting what? Period. Different accounting period. For example, in this case, you may be told that a company incurred a certain expense in the year 2024, and this expense will be taken into account or will be used in the computation of accounting profit, maybe during the year 2024. But this expense will only be treated as allowable expense, will only be treated as allowable expense maybe in the year 2026. So meaning that this expense will be used in the computation of the two profit, but in different accounting period. In computing the accounting profit, it will be considered in the year 2024. In computing the taxable profit, it will be considered in which year? 2026. Now, this is basically the difference which gives rise to deferred tax. Is the difference which gives rise to the deferred what? To the deferred tax. So the timing difference basically is the difference which gives rise to what? Is the difference which gives rise to the deferred what? Which gives rise to the deferred tax. Give rise to deferred tax. As Anne is asking what? Assuming practically the company has excess what? Excess refund claim from KRA. Is the deferred tax asset? Is this a deferred tax asset? Is this a deferred tax asset? It all depends. Basically, if a company has a tax refund claim, so the company is claiming a tax refund. A tax refund claim is usually an asset. Is usually what? An asset. That is the first thing. But if, for example, you expect to recover this, or maybe you automatically, does KRA refund? Yes, maybe you have the necessary documents, you can refund. But in most of the cases, you offset that maybe against the future what? Taxes. So usually we treat that as a deferred tax asset in case that amount of money is expected to be refunded beyond, for a period beyond 1 year. For a period beyond what? Beyond 1 year. But essentially, a claim for a tax refund is usually an asset. Is usually what? An asset. That's yes. Now, in this case, I want us to look on some few terms. Basically, we're going to come across in the computation of deferred tax. We look on some few terms here. Definition of terms. These are also terms you may be required to define in an examination setup. Definition of terms. So the first term here is something called the carrying amount, abbreviated the CA, carrying amount. So what is CA? So this is the value of asset or liability in the statement of financial position. So that particular value at which an asset or liability is recorded in the statement of financial position, we refer to it as the carrying amount. We refer to that as what? Carrying amount. For example, we know that items of PP are recorded here at their net book value. So the value at which an asset or liability will be recorded in the statement of financial position is the carrying amount. Number two, we have the tax base. Tax base basically is the value of an asset or liability for tax purpose. For tax purpose. For tax what? Purpose. Let me give a good example of maybe an asset which qualify for investment deduction, or for an asset which qualify for what? For investment allowances. This is something you did in PFT. There are those assets which qualify for capital allowances. Now, if you happen, for example, to own such an asset which qualify for investment or capital allowances, and basically you sell that asset. You sell what? You sell that asset. For you to be able to determine the amount which you're going to treat as a taxable income, or the amount which you're going to treat as deductible expense, you take the sales proceeds minus the written down value. Minus the written down what? The written down value. There is a name, I think, which was given to this in taxation. I think trading, are they called trading receipt? Yes, something like that. So the difference between the sales profit and the written down value. So that amount is the one which is allowable or deductible in taxation. So therefore, in computing that amount which will be allowable or deductible in taxation, what do we consider as far as this asset is concerned? The written down value. So therefore, tax base is the value of an asset or liability for tax purpose. So the other term is temporary difference. Temporary difference. Now, temporary difference, abbreviated as TD, this is the difference. This is the difference between these two values, the difference between carrying amount and tax base. Carrying amount and what? And tax base. So in other terms, to compute the temporary difference, we take the carrying amount minus the tax base, of which in this case, we can either get a positive figure here, or we can get a negative figure. So if we get a positive figure, that one is called taxable temporary difference. If we get a negative figure, that one is called deductible temporary difference. So therefore, in that case, we can say we have two types of temporary differences. We have the taxable temporary difference. Actually, this one is abbreviated as TTD. Just understand, remember those abbreviations. TTD, taxable temporary difference, whereas this one is called the deductible temporary difference. Deductible temporary difference. So therefore, here we have two types. Types of temporary difference are two. We have the taxable temporary difference, and number two, we have deductible temporary difference. Now, a taxable temporary difference, we say is a temporary difference which gives rise to amount which are taxable in the future. So this give rise to amount taxable in the future. Amount taxable in what? In the future. And because it gives rise to amount which are taxable in the future, we can also say that this will give rise to, or it results to, something called a deferred tax liability. So we can say this gives rise to deferred tax liability. Deferred tax liability. This gives rise to the deferred what? the deferred tax liability. Remember from our introduction here, we said deferred tax liability is a tax payable in the future. Why do we have a tax payable in the future? Because the taxable temporary difference will give rise to amount which will be taxed in the future, which are taxed in what? In the future. So therefore, the TTD, taxable temporary difference, give rise to deferred tax liability. Now, a deductible temporary difference, this give rise to amount which will be allowable in the future. So this one give rise to amount which are allowable or deductible in the future. The amount which are deductible or allowable in what? In the future. In other terms, you can say that this give rise to a deferred tax asset. This will give rise to a deferred tax what? Deferred tax asset. I will try to simplify this because I don't want to go into details. So just understand what Morimo is teaching you here, that in case we have a taxable temporary difference, that give rise to deferred tax liability. That's just what you need to know. No need of going into details as to why that will occur. The deductible temporary difference, this give rise to a deferred tax what? Asset. Sasa, and also you need to remember here, we have those two types of temporary what? Difference. We have those two types of temporary difference. Now, the other term we can maybe define here. The other term we can also define here. Number 4, that is term number 3. Number 4, we have basically what you have already mentioned here. Deferred tax liability. Deferred tax liability. And from my introduction, you've already said that these are tax payable by the company in the future as a result of taxable temporary difference. Tax payable in the future. Tax payable in the future. In the future as a result of taxable temporary difference. As a result of what? Taxable temporary difference. So therefore, how do we compute this one? How do we compute the deferred tax liability? This is basically one of the formula you need to remember. How do we compute the deferred tax liability? We take the taxable temporary difference. The taxable temporary difference, we basically multiply that with the tax rate. We multiply that with what? With tax rate. That formula you need to remember. That is one of the formula we're going to apply. The other term, the last term you need to know how to define here is the deferred tax asset. Deferred tax what? Asset. So deferred tax what? Asset. Now, a deferred tax asset, basically, this is a tax which is recoverable in the future as a result of deductible temporary difference. So a tax which is recoverable in the future as a result of deductible temporary difference. As a result of deductible temporary what? Difference. As a result of deductible what? Temporary difference. So therefore, to compute the deferred tax asset, so this is the formula which we use. We take the deductible temporary difference. We multiply this with the tax rate. We multiply that with what? With the tax rate. We multiply that with what? With the tax rate. There is also something you need to recall from something I've explained here, that this one, that is the taxable temporary difference. The taxable temporary difference, remember what I've explained here. I've said that taxable temporary difference, this one arises whereby the carrying amount, this is very important, the carrying amount of either an asset or liability, this one exceeds the tax base. This one exceeds what? the tax base. So if you're given the carrying amount, you're given the tax base of the company's net asset, you get the difference, and actually you compare the two values, and the carrying amount happens to be more than the tax base, the difference is known as taxable temporary difference. But in this case, the deductible temporary difference, this one arises whereby the carrying amount is less than tax base. Is less than what? Is less than tax base. So if the carrying amount is less than tax base, the difference between the two values, carrying amount and tax base, is known as deductible temporary difference. And actually we use that deductible temporary difference to do what? To compute the deferred tax asset. So I think, first of all, those are some of the terms you must be in a position to define. You may come across a question whereby you are required to define any of those particular two terms. You'll be able to see, I think there was a question some time back, which was requiring the candidate to differentiate between temporary difference, and timing. Was it temporary difference and permanent difference? Permanent difference and the timing what? Difference. We'll check on that question. Then from there, once we proceed and basically look on the approaches used in computation of deferred tax. Approaches used in the computation of deferred what? Deferred tax. If a company is computing the deferred tax, either the deferred tax asset or the deferred tax liability, which approaches can be used? Here we have two approaches which the company can use. Number one, we have the income statement approach. Income statement approach. Now, under this particular approach here, the deferred tax is basically computed using the difference between the taxable profit and the accounting profit. So here we can say the deferred tax is computed using the difference between accounting profit and what? And taxable profit. And I hope you can be able to recall this difference between accounting profit and taxable profit, we have said is broadly classified into two: the timing difference and the permanent difference. But in this case, we have said that the permanent difference is ignored for the purpose of computing the deferred tax. So therefore, the difference which is considered here is the timing difference. In other terms, we can say that under this approach, we compute the deferred tax using the timing difference. We compute the deferred tax using the timing difference. Now, this particular method here is not recommended by this standard. So we can say IAS 12 does not recommend the use of this method, does not recommend use of this what? Method. For example, if you check on the questions which are tested nowadays, they always require you to use the other method, the other approach. So there is no question will come across. Maybe some questions which were tested some time back, the candidates were required to use this method, but questions which are tested nowadays, they require the candidate to use the other approach. So this method here is not recommended for use by the International Accounting Standard number 12. So we have the last approach here, or the last method, which is known as number 2, the statement of financial position. In other terms, is also called the balance sheet approach. The balance sheet approach. Now, under this method here, we compute the deferred tax using the permanent difference. What is permanent difference? The difference between carrying amount and tax base of various items of asset and liability. So we can say here the deferred tax is computed using the temporary difference. Temporary difference is the difference between the carrying amount and the tax base of various items of asset and liability. So here we compute the deferred tax using the temporary difference, which is the difference between the carrying amount of tax base of asset and liabilities. And basically, this is the recommended approach. So we can say this is the recommended what? Approach. Recommended approach by IS 12. The International Accounting Standard number 12 basically recommend the use of this word method. And I've said, if you check on all the past papers, the recent past papers, you'll be able to see that all questions coming from this, they usually require a computation of deferred tax using using this method here, using the balance sheet method, or basically the statement of financial position approach. I think basically that's what you need to know. Maybe the other concepts you need to understand, maybe I'll be able to explain more on that as we do an illustration. As we do what? An illustration. Therefore, we will first of all take a short break. As we come back, there is a question I want us to do, a question similar to maybe a question there was a question which was in a file, and I think it was actually borrowed from the paper for AFR. That is a question I want us to start with, a question which was examined some time back, not too back. That is let me see the question here. Yes, so this is which sitting is this? November 2019, that is the question we are going to start with. Not actually, I'm saying these are questions which you came across in a PAL, CP intermediate level, because I think it was tested there. So November 2019, which is the question number what? Question number 5B. Question 5B. Question 5B. So we take a short break, 5 minutes or 10 minutes. We take a short break of 5 or 10 minutes. Yes, a break of 5 or 10 minutes. Yes, 10. We take a break of 10 minutes. We come back. Make sure you have that question with you. And then we do it maybe within the next 30 minutes, we'll be done. So see you after that short break. Yes, we continue. I hope you're back. Let's continue. Let's continue. Yes, so what are we told as far as that question is concerned? I hope you already have the question with you. Yes, do you have the question? Abdinasil, Mark, do you have the question with you? And Daniel, Douglas, do you have the question? Fred, Ismail, Reese, Mercy, Patrice, Phoebe, yes. Okay. So what are we told in this question here? That is question number 5B. So the question reads, Mafuta Limited has a deferred tax liability as at 1st of October 2018 of shillings 400 million. For the purpose of preparing financial statement for the year which ended 30th of September 2019, the following additional information is available. So basically we have number 1, you told the company is available for sale financial assets with a carrying amount of 80 million and financial assets at fair value through profit and loss of 40 million. Both financial assets reported losses in fair value of 8 million each as at 30th September 2019. Number 2, inventory is shown. Inventory is shown at the rate of the cost and the net realizable value. The cost is that 200 million, while the net realizable value is that 120 million. Number 3, can someone share that question in the class WhatsApp group? Someone to share that question. Orangi, make sure you have those past papers with you. Make sure you have those past papers with you. Yes, number 3, we are told receivables had a carrying amount of 2,000 million after making allowance for doubtful debt of 80 million and an exchange gain of 60 million, which is not yet realized. Both allowances and exchange gain are not allowed for tax purpose. Number 4, trade and other payables are stated that is 600 million after making provision for discount of 40 million. 5, a property, plant and equipment has a carrying amount of 4,800 million and a tax base of 4,000 million. Some rented buildings were revalued upward by 200 million during the year, which ended 30th of September 2019. 4, that is number 6, not note number 4. We are told intangible assets consisting of trade licenses being amortized over 5 years had a carrying amount of 240 million. And this was allowable for tax purpose in full 2 years ago. So number 7, income tax rate 30%. So what are we required to do in Roman 2? Or actually in Roman 1 of the question, we compute the relevant temporary differences, 8 months, and Roman 2, we make the necessary journal entries to record the changes in the deferred tax liability. So we start with the Roman 1 there, whereby we are required to compute the relevant temporary differences, or basically the relevant TD, temporary difference.